Hey everyone, welcome. It is 1 p.m. on May 1st. We just got that closing bell. We were expecting a volatile day because of the FOMC announcement and the press conference, and we definitely got it. So let's take a look at how all of that played out today. We were commenting in the morning how we did not expect to break out of this 500, 505 region until, I'm sorry, 500, 502 and a half region, maybe 505. I don't remember exactly which one we said, but we weren't expecting to break out of it until we got to the FOMC. And that's definitely what happened. We traded down to the 500 level, bounced off of it many, many times. And then when we got to the 11 o'clock announcement, that's where we started to see the volatility come in. And as we hit 11:30, when Powell started to speak, then we got a lot more volatility and we got the directionality that we thought we might get. Now, what happened? We traded right through the 505 level, pulled back and tested it, got close to the 508 and a half level, and then once he stopped talking, the market said, or institutions were like, well, now that he's done talking, we're not going to listen to anything that he said. And we traded down to the VWAP and then through the VWAP all the way back down to 500 and a half, it looks like, where we closed probably right around 500.5, basically almost all the way back down to the lows of the day, completely undoing what was done after the announcement and during the press conference. One thing to remember is a lot of times during the press conference, it's algorithms that are trading based on language patterns and based on the words that he chooses. They're able to process and trade so quickly. And that's why you get such a fast reaction based on what is being said. And humans, obviously, we can't react that fast. So when he stops talking, that's kind of when humans take over and go, well, whatever happened during the press conference happened during the press conference, and whatever the human has processed, now we get to trade in that direction. So what does this mean? Well, obviously, to reject all that motion upwards in the last half hour of trading, that's actually pretty bearish. And then we're sitting right here at support. So everything that we were talking about this morning, how we had higher probability of us moving lower, touching that MA90, well, we're that much closer to being at the MA90, and we are exactly at this horizontal support right here. And our probability of moving downwards through this MA90 just went up. Why do I say that? Because we went all the way up through the EMA 20 and completely rejected it and came all the way down. If we had stayed up there, that would have been a completely different story. Even if we stayed just below the EMA 20 or even right at the EMA 8, it would have been a different story. At that point in time, we would have said we'd have bounced off of that support and then we'd be in no man's land and it would look like we'd be chopping sideways. However, we rejected those levels really hard in the last half hour. We ended up with a red bar, so we closed lower than where we opened. And we are right on top of this horizontal support, which is at this point in time, basically the exact same level as the MA90. We're right at the bottom of that range, and all it takes is just a little bit more tomorrow, and we're below it. And then we're heading down to, I can't see what this level is, the 490 level. I drew in a little bit of support right here at this horizontal. It's not very strong. There's not a whole lot over there. And so after we get to this level, there's still a very good chance that we're going to go all the way down to either the MA150 or this 475 level, which would give us our 10 to 15% correction. It would be about 10 to 11% at that point in time. So right now, that is still looking like our most probable scenario. It's been enforced by the trading action today and the fact that we completely rejected all the gains that we had during the FOMC press conference. So now that that press conference is out of the way, what actually happens is a lot of this uncertainty goes away, which is kind of interesting. So we may actually see a collapse in the VIX because now we have one less uncertain report or uncertain news item behind us. So, I'm sorry, I should say ahead of us. We have one less uncertain report ahead of us. It's behind us now. So I wouldn't be surprised if that VIX fell lower, but the way that this rejected so hard in the last half hour, VIX might actually have spiked up, in which case that would make our downward bearish case even stronger. So let's take a quick look at that VIX. And it sort of spiked up, not really. We ended at 1539, which isn't that. So where did we start? Where did we close yesterday? 1564. Oh, so it's actually down a little bit from yesterday. Okay. So what I said held true. The implied volatility actually shrunk a little bit after the FOMC minutes, even though we're down in the markets. So normally we would interpret that as, hey, maybe the VIX is not supporting this downward move, but actually all that's happening is we have less uncertainty now that Powell has finished his speech or finished talking to the press. So I wouldn't be too disappointed that this VIX isn't up higher, and I would still anticipate that there's a very good chance that this VIX could continue to move upwards as we get a 10% correction. That's the higher probability possibility at the moment. The other thing we need to be aware of, though, is that we're still heavy in earnings season. So let's see if there's anything that is reporting immediately after the close, and we can see if perhaps they've already reported, or at least we're getting a reaction to those. And then what is reporting tomorrow morning, that'll give us a better idea of what to watch out for. So let's go over here to today after market close. We've got Qualcomm, MetLife, healthcare insurance. You can see these are all more like 50 billion and below. So they're not going to be as important unless they're a newsy or super well followed. So First Solar, maybe not really. eBay is not that relevant anymore. DVN in terms of the energy sector, but energy I think got hit pretty hard today, if I'm not mistaken. Yeah, I got hit pretty hard today because it seems like maybe we're making progress on some peace in the Middle East. We have a petroleum inventory report that reported tons of excess. So it's looking like we may have a weakening energy market or weakening demand in the energy market. And we'll see how well this EMA or this MA50 holds, though. We may bounce off of it, but based purely on the news items or the reports that are measuring the energy sector, we would expect that we might get a little bit more softening. So DVN, I would really only say it would only really affect the energy markets. CTSH would be a tech stock or IT stock, but they're not huge. They're well followed, but they're not huge market cap. CTVA, agriculture, same thing, well followed, but not huge market cap. AIG, Aflac, financials, Allstate, also financials or insurance. So really, I would just be looking at maybe Dash, maybe Met, maybe Qualcomm. Let's take a quick look at those. DoorDash. DoorDash would be representative of consumer spending, just like Starbucks was this morning. So far, it doesn't look like we have anything on. Oh, we do. Down. So definitely supporting our view from this morning that the consumer confidence is really getting hurt. Consumers are probably not spending as much as they were before. So that would indicate, at least in the short and medium term, a further weakening of the economy, which would drag down on the stock markets. Let's look at MetLife. They don't give us after hours, so they might not trade after hours data. And then Qualcomm was the big cap. Qualcomm up. Okay, so consumer confidence down, consumer discretionary down, but tech may be still doing okay. So those would have a balancing effect, although eventually the consumer confidence would probably win out Let's take a look at tomorrow before we open. ConocoPhillips, which is energy stock, so same thing as DVN, mostly going to affect the energy market, or the energy ETF, and not necessarily broader market. Cigna Group would be healthcare. Regen, or Regeneron, I guess that's a pharmaceutical. I'm not familiar with them. Esso, Southern Company, that's a utility. That will be kind of interesting to see for XLU. And then we have ZTS is also a pharmaceutical. Let's take a look at what happened in utilities today. Up. Okay, so it's looking like defensive sectors still may have been favored today, in which case we're still looking at a bear scenario. So let's take a quick look at what happened in our sectors. Utilities up the most, gold and silver up as well. So flight to safety type of assets. Communication, okay, so now we're getting some weird divergence here. Basic materials, and then we have small caps and treasury bonds, and then we have defensive and healthcare. So we definitely have all sorts of weird fragmentation going on right here. We have a mix of defensive sectors and risk sectors. Semiconductors way down, and communications up significantly. So even divergence within similar sectors. So we would just call this a completely mixed bag. And in order to remove confusion and fragmentation from the market, we need to come down. Of course, that's just 1 day data, so we don't want to read too much into it in just a single day. But a baby pullback or movement downwards on a 1 day basis could help unscramble that on the 1 day time frame. If we want to look at a more kind of stable viewpoint of what's happening in terms of sector rotation, then we'd look further and further out. So I might as well take a quick look at 1 month. And it looks like the defensive sectors are still leading on the 1 month basis. Take a look at 3 months, leading, or at least we're leaning towards them on a 3 month basis. And on a 6 month basis, we've got more of a mixed bag. So at least in recent months, we've started to move more defensively, and that makes sense as we pull back from the all-time highs in the S&P 500. So basically, everything that we're seeing here is still signaling a bearish direction. So our higher probability scenario is still, we're likely going to break through that MA90 and then start heading towards a 10 to 15% correction. At this point, if we just head to the MA 150, I believe that's more like a 10% correction. Okay, 9%. If we go down to this purple line, 9.3%. If we go down to the MA 200, 10.6%. So we'll call it 9 to 11%. Correction is what we're going to expect if we make it down below that MA90, which is the higher probability event. So we should still point our portfolios to slightly biased to the short side. We don't want to go completely short yet. We would wait for us to actually break below that MA90, perhaps retrace back to the support right here, which would then become resistance at around 500. And then when we get a confirmation bar back down, then we would lean full bear. So right now it's just baby bear. It's just leaning our portfolio to the bearish side rather than going fully to the bearish side. So either we have small allocation, small positions to the bear side, or we have long short pairs. We have pair trades where they're negatively correlated to each other. or well, at this point, it wouldn't make too much sense to have a portfolio hedge. In any case, however you want to accomplish it, we would just have a slight bear bias inside of our portfolios right now until we get that confirmation. So everything that we said was higher probability over the last 2 weeks looks like is playing out. We are moving along in the higher probability scenario so far, which is to be expected. That's why it's the higher probability scenario. And right now, there's no reason for us to believe that that's going to change. The only kind of maybe uncertainty is, do we break below that MA90, or does enough interest come back into the market where we actually just kind of chop sideways? So we bounce between that MA90 and MA50 for a while, sort of like we did for about a week so far right now. But right now, the higher probability is to move lower, and then we'd be looking at a scenario where we're probably going to get that around 10% correction. So in terms of sectors, right now it's pretty broad. As you can see, it was all jumbled up today. So I wouldn't necessarily be looking in terms of sectors. I would just be looking in terms of weak stocks that are really weak relative to the overall markets. And then if you needed to, then you would pair, or not pair, but you would long short so you would go long stocks that are extremely strong versus the market. So we're going to continue to lean our portfolios to the downside, and then wait for our signals to either back off and neutralize ourselves, or more likely to add on to our short position and then just go full bear. And when I mean full bear, I don't mean that necessarily that the markets become bearish overall on the long term. I just mean that for the time being of this correction, we want to be in the direction of the medium term or pullback, correction, before we see the possibility of being very bullish again later on this year, which would probably be end of summer or around election time, would be most likely when we could get back into a very bullish mode. I think that's everything we want to look at for today. Let me just think about things real fast. We could take a quick look at the CPC, but that's about it. CPC is at 0.94, so basically neutral. So all our signs are, I should say, more signs leaning towards the bearish side. So that's the direction that we're going to lean our portfolios. That's it for today. We're just going to maintain our slight bearish bias and stay the course. So have a wonderful rest of your day, and I will see you tomorrow morning in the pre-market.